Honestly, I didn't think I would be making this video, at least in this context. The Fed is flipping. Fed Mary Daly is now saying we need to cut rates in 2024 to avoid over-restriction on the economy. This is starkly different than anything she said in October, November, or months prior to that. We also have the biggest bear on Wall Street, Mike Wilson himself, that says now is probably a good time to own small cap stocks. That's way different than anything he's said over the past 2 years. What's going on in our markets? Well, we just seen a breath thrust, something in which a lot of you guys have not experienced in your investment lifetimes. If you've joined the markets in the past 2 years, you've never seen anything like this, besides a little bit in the summertime of this year. This, historically speaking, leads to some pretty strong gains. Now, next year, 2024, is an election year. What normally happens during election years that you need to know about? We're going to get into it in this video. So let's get started. First up, Goldman Sachs, just after 1 month after setting their 2024 target for the S&P 500, Goldman Sachs strategists increased their forecast as the year-end rally shows no signs of abating. Quote, "We raised our SPX year-end 2024 price target to 5,100, representing 8% upside. This outcome aligns with the scenario we outlined last week, where lower inflation and dovish Fed policies allow yields to fall. We raised our SPX year-end 2024 price target to 5,100, representing 8% upside. This outcome aligns with the scenario we outlined last week, where lower inflation and dovish Fed policy allow real yields to fall. Our 3-month and 6-month targets are 4,800 and 4,900. So Goldman Sachs is also caving to some of the bullish forces in our markets. Ryan Dietrich, he runs Carson Group. He's the chief market strategist. He writes on X, more than 40% of the components in the S&P 500 hit an RSI of 70 or higher last week. If you guys are unfamiliar, above 70 on the RSI means you're overbought, due for a pullback. He says, yes, we are super overbought, but also we see this type of action at the start of very strong moves. January of 1975, October of 1982, February of 1991, and July of 2020. And then now, up a year later, all 4 times, and up 25.7% on average. So normally what happens is you get this big breath thrust of stocks that start to do well because of this or that. They do well for a while. You get a consolidation phase, but they continue to go higher over the next coming months. Stocks above 70 on the RSI tend to come down. So don't be surprised if markets do come down a little bit and then continue to rally. Fed official Mary Daly says rate cuts could be needed next year to prevent over-tightening. She also says the Fed should aim to minimize job market disruptions if inflation continues to fall. She says more recent inflation declines have been demand-driven. Demand-driven inflation declines are a material development. Fewer cuts would be warranted if inflation progress stalls. She says 3 rate cuts could be needed in 2024 to avoid over-tightening. She says more cuts could be appropriate if inflation falls faster. Fed Daly says her economic projections were very close to the FOMC median. This is quite different than what Fed Goolsbee said earlier today, that he was confused by last week's market reaction. He says, quote, "It's not what you say or what the chair says. It's what did they hear and what did they want to hear," said Chicago Fed President Austin Goolsbee, said on Squawk Box. "I was confused a bit. Was the market just imputing, here's what we want them to be saying?" He says the market's expectation of the number of rate cuts is greater than what the SEP projection is. So kind of trying to push back a little of those rate cuts that are priced in. Following Fed Goolsbee's comments today, the odds of 6 rate cuts actually increased. So we were at 36.3%. Now we're at 37.6%. So you actually went up over 1% on Fed Goolsbee, which doesn't make a whole lot of sense, but it really just shows the markets are leading the Fed at this point, and the Fed is catching up to the market. Seth Golden on X says an extremely bullish signal of broad-based breadth momentum if 900 plus is achieved. Forward positive return rates, 3 months being 88%, 6 months being 85%, and 12 months being 94%. The median 12-month return is 13.5%, and we're getting pretty close to 900 on this chart. FX Evolution shares this chart on X that it's clear central banks worldwide haven't exactly been restrictive. And here you can see the global excess liquidity leading indicator has now went positive, and you really have not seen this since the start of this whole downturn in November of 2021. Yardini Research came out with a new piece, a dozen reasons to remain bullish in 2024. Number 1, interest rates are back to normal. Number 2, consumers have purchasing power. Number 3, households are wealthy and liquid. Number 4, demand for labor is strong. Number 5, onshoring boom is boosting capital spending. Number 6, housing is all set for a recovery. Number 7, corporate cash flow is at a record high. Number 8, inflation is turning out to be transitory. Number 9, the high-tech revolution is boosting productivity. Number 10, leading indicators are mostly misleading. Number 11, the rest of the world's challenges should remain contained. Number 12, the roaring 2020s will broaden the bull market. A lot of this is just generalized speaking. It's a lot more simple than that. If you want to be bullish in 2024, you just need inflation to continue to fall, and you need the economy to avoid a recession. That's it. 2 things. If those 2 things happen, we're just fine. According to Larry Williams, the average re-election year since 1956 looks something like this, from the start of the year to the end of the year. Now, this is what stocks could ultimately end up doing. If this is true, you would see a pretty aggressive continuation rally at least until March, with a pullback from mid-March through around July, recovering in here, but still a pullback from the March level. And then the second half of the year could be aggressive to the upside from August until really the end of the year. Now, history does not always repeat itself, but it usually does rhyme. Why markets tend to do better than average years during re-election years is because the government tends to spend more money. There can be a change up of policies. There's a lot of promises that are made. Most of those never actually get materialized, but those are some notable reasons. This time around, as Fed funds rates are projected to fall 6 times, I would argue could be a lot more linear to the upside. This is a chart of the inflows and the outflows by month to the Russell 2000 from November of 2021 through today. Today's date, December 18th. You can see we've had 2 solid months in a row, about $1.8 billion for November as well as December, but nothing that is really sticking out here on the bullish side. Obviously, there's a lot more red candles here than green candles, but you're not really seeing huge amounts of inflows as well. This is interesting, given the narrative that is shifting around small cap stocks, really interest rate sensitive names, which a lot of those tend to be small cap stocks. A lot of institutions are starting to recommend them. I think this shows you're probably not overbought on small cap stocks, considering the market cap of the entire Russell 2000 is roughly $2.76 billion, and there is roughly $6.2 trillion in money market funds. You could make the argument IWM could rally 50% or more, in which that's the argument that Tom Lee with Fundstrat actually is making. Yeah, this guy, does he look familiar? That's Tom Lee, the head of Fundstrat. This article says, the Wall Street bull who called this year's stock market rally says small cap stocks could surge 50% over the next year. Next year will all be about fading inflation and interest rate cuts, according to Lee. And that should benefit the small cap stocks that have been hit the hardest by rising borrowing costs. Small caps tend to have higher leverage, which means the Fed's interest rate hikes over the past 18 months have dramatically affected their bottom line. As a result, the Russell 2000 is up over 14% this year compared to the S&P 500's roughly 23% rise. And a vast majority of this 14% increase has come within the last 2 weeks, I should point that out. But if inflation continues to fade in 2024, leading the Fed to cut interest rates as it now widely forecasts, that could be a boon for small caps, and Lee is convinced inflation has already been tamed. He says, quote, "I think inflation is easily going to hit the 2% core target sometime next year and sort of stay there," he said. Quote, "Housing and cars alone account for 1.74 percentage points of the excess inflation. We're at 1.6% of excess inflation. So literally, those two things account for all the inflation," he noted. As long as housing inflation, quote, "stabilizes at 6% and car prices continue to fall, Lee believes inflation will drop to the Fed's 2% target and stay there in 2024. This week, we do have important data coming out. The GDP growth rate quarter over quarter final numbers for Q3 are expected Thursday at 8:30 a.m. at 5.2%. Right now, you want to see the economy holding up and doing well. You don't want to see the economy doing poorly. Right now, that's going to, yes, mean more rate cuts from the Fed. We might start to price in 10 rate cuts if it looks like we're heading into recession. But a recession is ultimately going to be bad news for stocks. So you want to see good data. Now, we're also going to get on Friday a bunch of data. Core PC price index month over month for November. You're expecting 0.2%, the same as last month. If this can come in at 0.1%, as I expect it might, that would be huge for stocks. And I would expect, especially small cap stocks, to have a wildly bullish day on Friday. Durable goods orders for the month of November are expected at 2.2%, in line with what my estimates are. Last month, you were negative 5.4%, so that would be a very healthy number. Now, personal income month over month is expected at 0.4%. That's just fine. Real wages starting to go positive. I don't think this matters all too much. Personal spending month over month is expected at 0.3%. Last month, it was 0.2%, so 0.3% would be good. Definitely would show we're probably not heading into this imminent recession. 10-year Treasury yields continue to be on the decline, down about 1.5 basis points currently to 3.94%. The 10 and the 2-year yield curve inversion is inverted 53 basis points and continuing to invert even more. What's notable here is when you actually break above the black line and the yield curve goes positive, that's when you tend to actually get the steep decline in markets. That's when the recession stop clock actually starts. But as of right now, the bulls are in full control, as you can see from this AI investor sentiment survey. Bullish investors at 51.3%, neutral investors at 29.4%, and bearish investors hitting a new one-year low at 19.3%. But again, don't be surprised if we do get a pullback for a couple of days. If you look at IWM, the ETF for small caps, you are at 74.73. Rightfully so. I mean, small cap stocks should be doing well right now. And on a technical basis, you're at the higher end resistance line, and you hit 200, got rejected a little bit there, but looking good overall. But your RSI suggests we could be coming down or consolidating for a period. SPY as well, RSI is at 79.66. Definitely on the overbought side. Again, fundamentally justifiably so, but still, that probably sets us up for a near-term pullback. Let me know what you guys think about this major flip-flop across the board. Everyone seems to be getting a lot more bullish on small and mid-cap stocks, the specific area in which I want to be invested in for 2024. That's where some big gains could be coming, in my personal opinion. I don't think Apple or Microsoft or Google or Amazon or Nvidia, for that matter, are going to do much of anything because they're not interest rate sensitive. You can make the argument that besides Nvidia, those other names actually get hurt by the Fed lowering rates because for one reason or another, but really because they're not interest rate sensitive. So let me know down below in the comment section where you are positioning your portfolio for 2024. Let me know what you guys think about this flip from Mary Daly, as well as Goldman Sachs and others. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.